Welcome to Chapter 7 of the Conduct and Practices Handbook course. In this chapter, we are going to be looking at trading, settlement, and prohibited activities. So to start, how are securities traded? So there is what's called standard trading units, and this is for the Toronto Stock Exchange and the TSX Venture. So basically, when you are buying stocks, they will be traded in what's called the standard trading units. So if you're buying a stock for less than 10 cents per share, the standard trading unit for those shares are 1,000 units. So basically what this means, if you're looking at trading some sort of penny stock, let's say it's 5 cents per share, and you want to buy let's say 1,500 of them, it's going to actually trade in two separate orders. So it's going to trade that first order at 1,000 units, and then it's going to trade an odd lot order for the extra 500 units. So you do sort of need to know this. It might be important for the exam, but basically, if the security price is less than 10 cents per unit, your standard trading unit is 1,000. Between 10 cents and $1 or 99 cents, the standard trading unit is 500. And then anything above $1 per unit is 100 trading units. So again, say you're buying some stocks, say it's a bank stock, so say you're buying Bank of Nova Scotia or whatnot, that's at about $90 per share. So it's way above that $1 per unit. The standard trading units for those shares would be 100 units. So if you were looking to buy, let's say 120 units, you would trade, you would actually do that trade in two separate orders. The first one in the 100 units and the second one in that additional odd lot of 20 units. And because of this, it can be more difficult to fill orders for those odd lots, and the price obtained may actually be a bit higher than the price you get for the standard trading units. Of course, it is only marginal, not really something to worry about, but it can happen. Now, how are securities traded? And there are some sort of settlement periods with stock trades and bonds and whatnot. So for Government of Canada T-bills, it actually settles or trades and settles on the same day. So T is the trade date. So say you bought a Government of Canada T-bill today, that trade actually settles on the exact same day. Whereas if you buy a Government of Canada bond, so let's say you buy a 10-year bond, this is T plus 2. So you buy it one day, it settles 2 business days later. And the same goes for preferred shares and common shares. So T plus 2, you buy it one day, it settles 2 business days later. And it also works the same with mutual funds. They are T plus 2. The industry is trying to move more towards T plus 1, but for now we're at T plus 2. There's also minimum quotation spreads. So when clients sell a security at the market price, they receive the bid price. This is the highest price any buyer is willing to pay. When the clients sell a security at market, they pay the ask price. And the minimum quotation spread is the minimum acceptable range between that bid price and the ask price. And when quotations are given for securities. So for any security under 50 cents, the minimum quotation spread is half a cent, and anything above 50 cents is 1 cent. So that's why you might see some penny stock trading for, let's say, 10.5 cents, because that quotation spread is actually half a cent. So that is why you might see that in a smaller stock. And here's an example of a sample order ticket. Of course, you will probably be filling these out online or on a system and not actually by hand on an order ticket. But of course, you have all of the important information. You have the quantity that you're looking to buy. You have the security that you're buying, the order, so whether it's a market order or a limit order, stop order, whatever. You have the price, so since it's market, you're just buying it for the market price. Good till, day orders, client name, new account, and then account number and whatnot. So this is basically a sample order ticket that you might want to understand for the exam. Orders categorized by duration. So these are different order types. So if we go back to that sample ticket, this slot right here, so there's various different order types that you can use when buying stocks. First is the day order, and this is an order to buy or sell, which if not executed expires at the end of the trading day. You have a good till canceled order, also known as an open order. This is an order to buy or sell that remains in effect until it is either executed or canceled. And good till canceled order on the TSX expires 90 calendar days after the entry. A good till date order. This is valid until filled or canceled, or until the close of business on a specified expiry date. So this type of order is particularly useful with clients who are hard to reach or are leaving on vacation or a business trip. There's also, of course, the market order and the limit order. Market order is an order to buy or sell securities at the prevailing market price, and a limit order is an order to buy or sell a security at a specified or better price. You also have the on-stop sell order. This is often referred to as a stop-loss order. And it's an order that is specifically used in connection with a sell order where the limit price is below the existing market value. So it's good to look at the example for this one. So, for example, if the client says, sell my stock if the price drops to $20, then the order would be triggered as soon as the stock's price fell to $20 or lower. The purpose of the on-stop sell order is to reduce the amount of loss that might occur or to protect at least part of a paper profit when a stock's price declines. There's also the on-stop buy order, and this is the opposite of an on-stop sell order. So in order to buy a stock at or above a certain price, so for example, if you ask to buy a stock only if it moves up from $30 to let's say $35, then a limit buy order of $35 would immediately be filled because the trader is obliged to buy the stock at $35 or better. There's also the all or none order. This is an order for which the entire amount of stock must be bought or sold, or no part of the order will be executed, and the client will not accept partial fills. There's also a fill or kill order, and this is an order in which as much as possible must be filled immediately, after which the balance of the order is canceled. A switch order is an order for the sequential sale of one security, and then you use the proceeds to purchase another security. You also have a contingent order, which is an order that takes second place to a primary order, and a primary order and one or more contingent orders are entered into the trading system simultaneously. You also have delayed delivery order, which is a special term order in which the buying and selling parties agree that delivery of the securities will be delayed beyond the usual 3-day settlement period to a date specified in the order. There's also the short sale order, which is an order to sell a stock that the seller does not currently own. So basically, you're borrowing the stock to sell it. And short sellers, there is a lot more risk with this because, of course, if the stock skyrockets in price, they don't actually own the stock that they sold, so they will need to buy it back. So there is a lot of risk with this type of order. There are some other types of orders, not as common, but there's a professional order, also called as an employee order or non-client order. So, for example, a financial advisor, they would have what's called a pro account, and they'd set a pro order whenever they enter a trade. And basically, such orders should be marked as pro orders. And basically, the client orders will be given priority over these pro orders. There's also cancel or change former order. So a cancel or change former order, or CFO, is a cancellation and amendment to a previous entered order. Sometimes you must submit all changes to orders in written form, but often automated order systems will accept CFOs right from the RR's computer. Next, we're going to look at fixed income trading. So again, like we looked at the stocks, bonds actually do have their own trading units as well. So you have the GOC, or the Government of Canada T-bills. So the trading unit for this is $250,000. And of course, T-bills is anything maturing in less than 1 year. You have Government of Canada direct and guarantees with terms of 1 to 3 years. This is a $100,000 par value, and the same with anything over 3 years. So basically 1 to 10 plus years is a $100,000 trading unit. You have provincial bonds and guarantees, as well as all other bonds, so municipal and corporate bonds. They're all $25,000 par values. Bonds, convertible debentures, and debentures issued at a $5,000 par value with attached stock warrants. These all have $5,000 par values. Common and preferred stock not listed on a recognized exchange. So this is a bit different. Basically 500 shares if the market price is below $1. 100 shares if the market price is at $1 and below 100, and 50 shares if the market value is over $100. Next, we're going to look at sales and trading conduct. So again, like I mentioned, client priority. So when we were looking at the pro order, orders for accounts and partners, accounts of partners, directors, officers, RRs, and employees of a dealer member are generally considered a pro order, and they will rank behind any client order of the same dealer member for the same security at the same time and same price. And this is basically to avoid advisors taking advantage of their situation and not putting the client first. You also have best execution. So dealer members must consider price, speed of execution, certainty of execution, and total transaction costs when achieving best execution for all client orders. Gatekeeper obligations. This refers to dealers and all of their employees who are responsible for protecting the markets from potentially illegal client activities. The text also does discuss some universal market integrity rules. So 2.2, respecting manipulative and deceptive activities, respecting improper orders and trades, respecting front running, which is basically when a advisor puts their order ahead of a client order. You have dealer member rule 1330, respecting best execution of client orders. 5.3 is respecting client priority, and 6.4 is respecting trades to be on a marketplace. You also have the Anti-Money Laundering Act, which basically means that suspicious transactions that raise reasonable grounds to suspect a money laundering offense must be reported to FINTRAC. And failure to report a suspicious transaction is an offense punishable of up to 5 years of imprisonment, a maximum fine of $2 million or both. FINTRAC has legislative authority to issue an administrative monetary penalty of up to $500,000 to reporting entities that are in non-compliance with these rules. And here are a list of some prohibited activities. So one, front running, which we did touch on, is when a dealer member trades ahead of and to the disadvantage of a client order. You have insider trading, which is based on material non-public information about the affairs of the underlying company. So knowledge of a large order may not be material information, but profiting off of it is illegal. So you cannot basically trade on any material non-public information that you might get from someone who is involved in that company. Churning is another prohibited activity, and it's the act of carrying out multiple transactions in a client's account solely to increase the IR's commission. So for example, if you're buying and selling stocks quite frequently just to or just for the advisor to get paid that commission on stock trading, that would be churning, and it may constitute failure to deal fairly, honestly, and in good faith with a client. The following are prohibited sales. So sales made outside of a jurisdiction. If you are not registered in the province where the client is living, you could be subject to action by the relevant administrator. You also cannot take a trade for a client who is in the US or abroad. Sales of unqualified securities. So it is illegal for RRs to trade in most securities that have not been qualified for sale in the client's province of residence. And legal representation to effect a trade. So RRs are subject to penalties for making statements that are deliberately false in any material way. And manipulative trading practices. So you do have deceiving or attempting to deceive the purchaser or vendor of a security, creating or attempting to create a false or misleading appearance, entering or attempting to enter into any scheme or arrangement to sell and repurchase a security in an effort to manipulate the market, misleading and taking the side of the market opposite to the side taken by the client. These are all manipulative trading practices that you cannot do in the industry. We also do have some definitions in this chapter that I want to cover. First is firewalls. These are information barriers that separate persons who make investment decisions from persons who are privy to undisclosed material information. You have restricted lists, a list of issuers with whom a dealer member has a current publicly disclosed involvement, requiring restriction on the dealer member's trading or advising activity. And you also have the gray watch list. And this is a limited circulation list of issuers on which a dealer member has confidential information. It is distributed for the purpose of watching for any trading activity suggesting that the information has been leaked or has been used inappropriately. Now, there are some insider reporting requirements. So as I talked about with insider trading, there are some requirements with that. So insiders must inform the relevant Securities Commission when they become insiders, and also when they transact in securities of the company of which they are insiders. So basically, there is a process that insiders do need to take in order to actually buy or sell stock in their company. So if you recently, follow Tesla or Elon Musk, you'll notice that he actually did sell quite a few of his Tesla shares. And he needed to go through this process in order to sell them, since he is an insider in that company. So the definition of reporting insiders is limited to the CEO, CFO, COO, and the directors of a reporting issuer, a person or company responsible for a principal business unit, a person or company that has beneficial ownership or of more than 10% of the voting rights of an issuer's securities, any other insider who has both access to undisclosed material information and can exercise significant power or influence over the business. So if you are any one of those, you are considered an insider for that company. You also do have settlements, transfers, and corrections. So the clearing system, which is the Canadian Depository for Securities, or CDS, it operates for dealer members and participating banks and trust companies, and it acts as a central facility through which settlements of security transactions occur. You also have transfer of securities. Is what's called a simple transfer, which occurs when the beneficial owner of or registered shareholder is an individual. And you also have a transfer involving legal documentation. This is when the beneficial owner or registered shareholder is an entity such as a corporation, partnership, or investment club. And so basically that is all I have for you guys for Chapter 7 of the Conduct and Practices Handbook. Again, if you guys have any questions about anything in this chapter, let me know in the comments down below and I'll try to help you guys out. Yeah, I really hope you guys found this chapter helpful and stay tuned for Chapter 8.